You know, you turn on the news or scroll through your feed and you inevitably catch phrases like, the market is up, or in a way more panicked tone, the market just crashed, right? We hear it literally all the time. But underneath all that financial jargon, what are the actual mechanics driving those headlines? Well, today we're going to strip away the noise.
Welcome to This Explainer. Today we're absolutely demystifying the financial world's engine. Trillions, and I mean trillions of dollars change hands globally every single day. And to truly understand how that immense wealth moves around, we really need to revisit the foundational architecture of the market itself. So let's get into it.
Okay, let's dive into this. Here's our roadmap for today. First, what is a market? Second, 5 types of markets. Third, inside the stock market. Fourth, why do prices move? And finally, traders versus investors.
All right, part 1. What is a market? The basics of buying and selling. So a market, at its very core, is simply a place where buyers and sellers meet to exchange goods, services, or financial assets. Think of a bustling physical vegetable market or a livestock fair. It's the exact same concept. Whether it's a historic, chaotic physical trading floor or a super modern, high-frequency digital server executing trades in literal milliseconds, the basic principle remains exactly identical. Willing buyers meet willing sellers.
Let's move on and see how this builds in part 2, 5 types of markets, from gold to crypto.
You see, we operate within several distinct market types. First up is the commodity market, where you're trading physical items, like gold, silver, and crude oil. Second is the massive Forex market, which is all about exchanging global currencies like the US dollar or the euro. Third, we have the bond market, where governments and corporations essentially borrow capital. Fourth is the 24/7 cryptocurrency market for digital assets like Bitcoin and Ethereum. And finally, number 5, the stock market, where ownership in publicly traded companies is bought and sold.
Which brings us right to part 3, inside the stock market, buying a piece of a business. Now, there is a totally crucial mindset shift required right here. When you buy one share of a company, you own a tiny part of that business. You literally become a part owner. It's like you own a tiny brick in their headquarters. The direct result of that, your own capital is tied precisely to that specific business's performance. If they innovate and grow, boom, your investment value scales up. But if they mismanage things or fall behind the competition, your value drops.
And to actually facilitate this massive, continuous exchange of company ownership, we rely on dedicated exchanges. In India, for example, the 2 major heavyweights are the National Stock Exchange, or NSE, and the Bombay Stock Exchange, the BSE. The entire purpose of these entities, the whole shebang, is to act as a highly regulated middleman. They provide a secure, totally transparent platform so millions of us can trade shares instantly and safely.
Moving right along to part 4. Why do prices move? The engine of the market.
Okay, let's picture this. Imagine a scenario where 1,000 people desperately want to buy a specific stock, but only 500 owners are actually willing to sell. You've got double the eager buyers compared to willing sellers. And this brilliantly illustrates the core engine. Because the demand heavily outweighs the available supply, those buyers actually have to bid up the price to convince those few sellers to finally part with their shares.
And so, this brings us to the absolute golden rule of trading. If demand exceeds supply, the price rises. Conversely, if a sudden panic hits and everyone rushes for the exit with literally no one on the other side willing to buy, supply overwhelms demand and the price plummets. This foundational tension, this constant push and pull, is the underlying force driving every single financial chart in the entire world.
Now for part 5, traders versus investors. 2 approaches to the market.
Why do people actually participate in all this? Well, it really all comes down to a fundamental difference in mindset. Traders look to profit from short-term price volatility. They're buying and selling quickly based on real-time shifts in supply and demand. Investors, on the other hand, well, they zoom out. They focus on the long-term compounding growth of a company over years. They're way less worried about daily fluctuations and far more focused on the fundamental health of the business. But so, the crucial point is this. Both strategies absolutely rely on mastering market mechanics.
All right, let's do a rapid-fire recap here. Step 1. A market is simply a hub for asset exchange. Step 2. We have 5 main arenas, everywhere from commodities to stocks. And step 3. The absolute ironclad law of supply and demand dictates every single price tick you see on your screen. Mastering these three concepts, that is your non-negotiable first step to actually understanding the financial world.
So we've laid down this great macro foundation today. But what happens when you actually click that buy button on your app? What exactly is a stock at a micro level? And how does the digital process of claiming your tiny piece of a massive global corporation actually work behind the scenes? Well, that is a fantastic puzzle for next time.